All right. Well, good afternoon, everyone, or good morning if you're in Hawaii. Welcome to another edition of the Mortgage Law Today web show. Very excited today, very honored, frankly, to have Mitch Kider with a bit of a one-on-one. We're normally brought to you by the Polonsky Beidel Green guys in Texas, and they usually have one person join us. I'm also usually joined by Loretta Salzano, but Loretta, I think, is in parts unknown. And the PBG guys are going to come back next month. But meanwhile, it's just me and Mitch, if you are watching the Mortgage Law Today show and don't know who Mitch Kider is, it must be your first day on the job, because Mitch is probably the most well-known and in my book, respected mortgage banking attorney in the country. We're going to get to know Mitch a little bit better, I think, today. I think you'll all enjoy this. I know I'm really looking forward to it. I've known Mitch for at least 30 years, and I think this will be a fun little conversation that we're going to have. Before I get going, Mitch, any introductory words you want to correct me on here?
So I'm glad to be here with you. We have known each other for about 30 years. We were young men back then, and look forward to this conversation. It should be great.
Awesome. Terrific. Well, what I'd like to start with is to get a little bit of your personal background. I think some people may have heard some of the stories about your parents. I know you've done some things with the Mortgage Bankers Association along those lines, but I'd like to hear maybe your story a little bit. If you could repeat that maybe for folks who haven't heard it, and also tell us a little bit of how you got into mortgage banking law.
Oh, sure. Happy to tell you about that stuff. So I am a product of New York City, born and raised in Queens, New York, place that I loved. My parents were refugees to this country. They are Jewish. I am Jewish. My mother was in a concentration camp, Auschwitz, thought of as the worst of the worst concentration camps and places anyone could ever be. She was a slave laborer there. My grandparents were all killed by the Nazis in Auschwitz. And my father, who came from a little town in the Ukraine, was a wonderful, wonderful man, as my mother was a wonderful woman. And
how old was your mom when she was in the concentration camp?
She was 16 years old.
Wow.
Only 16 years old when she was in a concentration camp. My father escaped the Nazis, his entire family, except for one other brother who was a baby at the time, and was taken to Moscow, which the Nazis did not reach. But my father lost his entire family, and it was a big family. And he was a Russian. Actually, they called it Russian back then. I don't want to get into the politics of it all. His hometown was in the Ukraine, but there was no country called the Ukraine back then. And so if you asked him what he was a Russian, and he spoke Russian. And he escaped the Nazis, and he lived in the woods. If you've ever seen the movie Defiance, you're almost watching my father there, quite frankly. Yeah, he saved a lot of people. He joined up with the Russian partisans. He fought the Nazis. He saved people's lives. He was a great, great man. And when he died, people came to his funeral that were the children and grandchildren of people that he saved in the woods. So it was really quite amazing.
That's a great story. Thank you for sharing that. So how did you get into mortgage banking law?
Well, it's interesting. So, having grown up, not wealthy at all, lower middle class, blue collar family in a blue collar neighborhood in New York. I always recognized how important home ownership was. I always recognized how important it was to my father, and my mother. And I've told this story before. The NBA has made a movie about this before, little 4-minute movie about, every time we went into Manhattan, we'd get on the Williamsburg Bridge, and my father would look over to the left as we got on this ramp, and there was this great, big, beautiful bank, the Williamsburg Savings Bank, which is still there, quite frankly. And he would always say, as if we never heard this before, that's the bank that gave me the loan to buy my house. So home ownership was important in my house and in my neighborhood for the people that lived in homes. It made a difference in many, many, many people's lives at the time and for the future as well. So it's something that always interested me. How'd I get into this particular aspect of it? I guess it started in college. I got to college, and I was pretty political back then. There was a mayor. His name was Paul Soglin, and he was the president of the SDS during the Vietnam War, who went mainstream, became mayor of the city, and he was an excellent mayor.
That was Madison, right?
I was in Madison, Wisconsin. And I actually called up his office and I said, "Hey, I'd like to come work over there. You got an internship or anything?" And they said, "Hey, let me talk to Paul and we'll invite you in." And they invited me in, and I sat down and we talked about kinds of things I was interested in. And he said that he wanted to start the first of its kind in the nation, a mediation board for renters. And it would be composed of a landlord, a homeowner, and a tenant representative. And they would mediate disputes and try to get the housing stock fixed up in the city and do things like that. And he asked me if I had an interest in it. So I actually did all the research for it. I was a freshman in college, and I initiated that. We put together the first tenant landlord rental relations board in the country, which was quite amazing, and it was written about quite a bit at the time. And that's
well, thank you for that, because both of my kids live in Madison now and they're renting, so they may need the assistance that you commenced with that body. So hopefully not. Hopefully they'll have happy relations with their landlords, but you never know.
Yeah. I started that when I was 17, to tell you the truth. And, because that's how old I was when I went to college. I turned 18 in my freshman year. And after that, I got very much involved in housing related issues outside the mayor's office, inside the mayor's office. So then when it came time to go to law school, it's something that I wanted to pursue. And there's a professor at Washington University in St. Louis, whose name is Daniel Mandel. He actually just retired 2 years ago at the age of 95. He was a great man, and he is the in the legal community, he's the father of urban law and environmental law and land use law and things along those particular lines, very well known. And I said, all right, I'm going to go to school there and I'll get to know him a little bit. And much to my surprise, when I got to school there, he came looking for me and asked me if I'd be his research assistant, which I did. And we worked on a number of different housing related matters, but a lot of it had to do with Ginnie Mae and Fannie Mae, because it was at that time when new initiatives were just really taking off, and securitization of mortgage-backed securities was just really starting. And so we worked together on that. So when I finished law school, I was like, what am I going to do now? I loved being a trial attorney in law school too. I did really well. Won the school's mock trial, and enjoyed that. He said, my friend Jane McGrew is the general counsel of HUD. This was during the Jimmy Carter administration. Let me call her up. So I went and visited, and she said, I'll give you a job. You'd be an honors intern at HUD, and you can do both. Be involved in housing policy and finance policy, and you can try the cases when you are regulating mortgage bankers. And I said, well, sounded like a good deal.
What year was that?
How it started. So it was 1981. By the time I got there, she wasn't there anymore because Jimmy Carter lost the election at the end of 1980. And President Reagan, was inaugurated in January of 1981. And it's pretty funny because when I got there, people were like, well, what are you doing here? What can I tell you?
So what were you doing there?
But they were good enough to keep me there. They they followed through on a promise. They put me in an office that regulated mortgage bankers and went after mortgage bankers, banks, depositories, non-depositories, everyone else, and those that violated their rules and requirements. And that's where I learned this business.
Well, let's finish it up. How long were you at HUD?
I was at HUD just a little less than 5 years.
And then what'd you do after that?
So when I was at HUD, I actually went and took an action against a mortgage lender. And it was a big mortgage lender out of Columbia, Maryland. And I took the case to a trial. And it was because they had some real issues in the origination of some loans. And I won the trial. Okay. And a law firm where some of my partners today practiced offered me a job. They were on the other side of the case. And they said, wow, we hated you as an opponent, but we have a lot of respect for you. Would you ever think about coming into private practice? And I said, yeah, make me an offer. It was time for a change. Almost 5 years in the government, it was time to move on. And so I left and I went into private practice. And I practiced with them at that firm they made me a partner after, can't remember, 2 years, 3 years maybe. And then we basically decided to do our own things. And some of those partners are with us, but we started the firm that's our firm now, my firm now, back in 1992.
Would you say that in 1992, when you started, that there were any firms that sort of specialized in mortgage banking?
No, we were the only ones, really. We were really the only firms that did this. We were the first of its kind. We were a Washington, D.C. law firm. And, everything was happening in D.C. at the time, all the regulatory work to make Ginnie Mae really work. And a lot was happening at Fannie Mae and Freddie Mac. And, many of the programs that you take for granted today, they were just coming into existence at that time. And we thought it was a really good idea to do that. There was a firm, Brownstein, Ziidman, and Schomer, who were beginning to develop a little bit of a practice along those particular lines. And they did. And they did ultimately do that as well. In fact, they were the predecessors to what is now the Mayor Brown practice by way of K&L Yates. But when we started it, it was us.
Would that have been in like Larry Platt and Phil Schulman and a few others I'm sure I'm forgetting?
So Phil and I worked together in the government, and we left at the same time. And I went to the firm that I won this case against, and Phil went on to work with Phil Brownstein. That's exactly what happened.
Well, this is a good segue into our next topic, or at least the next one on my list, which is I'd really be curious to hear your observations on the evolution of the role of legal and compliance advisors in mortgage banking that you've seen over that time period, because you've seen it from the beginning to today.
Yeah, I'll tell you, it's been quite an evolution. When I first started this firm, and when I first began representing mortgage bankers, even prior to starting, our law firm, many of the mortgage bankers that we represented, even those that were at the time savings and loans, thrifts, things of that sort, they didn't actually have in-house counsel. Some of them had compliance officers. Many did not even have in-house counsel. When I grew the business, I grew it by way of going out and meeting with and speaking to the C-suite, the CEOs, and there was a great need for it. But it was very interesting, back in 1992, some of the larger banks designated specified attorneys, in their general counsel's office to take care of the mortgage banking divisions. But many even then didn't. And the expertise did not exist within the companies themselves. So it changed a lot. I mean, the truth of the matter is the mortgage banking industry grew exponentially in many ways, not just in numbers, but in sophistication as well. And there was a need to have in-house counsel, and there's certainly a need to have good compliance in-house. And so, you saw that grow over time to the point that it is right now.
Yeah, and I think, back when I started as in-house counsel of a thrift, as you suggest, we did almost exclusively mortgage banking and wholesale, retail, and second mortgage lending. And Wiener Brodsky even represented us at that time.
Yeah.
Matters. Actually, mostly it was your partner, Jim Brodsky,
Okay.
who's a wonderful man, and please say hello to him for me if he's not watching this already. In any event, I really was one of the few people that was doing that kind of work in-house. And so I completely agree with what you're saying. Let me shift gears a little bit here. You mentioned talking to CEOs, and at least in my practice, I find that I get business either from in-house legal or compliance or directly with CEOs. And sometimes you develop very close relationships with these people. People in mortgage banking are wonderful people. I found, just really lovely people who are driven, and you can form very strong relationships with them. But I'm wondering, in fact, you even mentioned a story to me once when we were working on a transaction about how a client had been just a wonderful person. And how do you, as a lawyer in these relationships, and frankly, I struggle with this too, is, you're a lawyer, you've got to be dispassionate, you've got to be, objective, and yet you develop these relationships with people that are very strong and can influence your thoughts. Just any comments about kind of dealing with those kinds of friendship issues?
Well, much of the relationship is, the friendship, the bond that you that you build is mutual. But much of the professional relationship is a one-way relationship. These are CEOs. You're absolutely right. Mortgage bankers are wonderful people. These guys are the best, right? And they just want to do what's right. They really do. And they want to grow, their circumstances are different. Are they part of a bank? Are they an independent company? Are they publicly traded? Anything else along those lines? So there's lots of different pressures on them. So you have a one-way street of issues coming to you as their friend and trusted advisor, and a one-way street going back. How can I help them? What can I do for them? How do I handle those things? And, it works really well, but it comes down to a trust that's developed. And it's really, your clients have to trust you. They have to know that you're in their corner. They also have to know that you know what you're talking about. Two absolute critical things, right? And that's the way those relationships are formed.
Yeah, no, I completely agree. Sometimes it can be challenging in those environments when you really do want to help somebody, because not just because you're their lawyer and they're paying you, to give them advice, but also just because you like them and you want to see them succeed.
Yeah.
And sometimes you have to tell them, you can't do what you want to do.
Yeah.
You got to do it a different way. You're not thinking about it right, or we need to push you in a different direction. And that can be that can be an uncomfortable conversation for anybody in a compliance or legal role, but that's what you got to do. I mean, that's your job.
So you have to do that. That is your job. And I guess, the only way I look at it is I don't find it to be uncomfortable. I find my job to be to do the best I can do for that particular company. And sometimes that involves educating anyone and everyone as to why they're wrong about something and telling them you can't do what you want to do. And then working with them as to what it is they can do. And what is the goal and how do you otherwise get there? But in all honesty, Brian, I have never, and I just think it's my personality, I've never been uncomfortable telling people what I actually think they need to know. And if they get it, if they have it wrong, I'm going to tell them. I'm just going to put it right out there. That's my job. And I think that's what they want me to do. So I've always looked at it that way.
Yeah, I think you're absolutely right. You can't be worried about disappointing somebody with your counsel. It is what it is. It's going to be good counsel, and if it's disappointing, that's you just have to deliver it.
Yeah, and no one wants to hire an attorney that's just going to be a yes man, because you know what, you're going to get in trouble.
People say that, Mitch, but sometimes they do want a yes man. And if they don't, or they don't like your answer, they go to a second opinion. But that's like I've heard. Well, what does Kider say about that? Well, I might say, well, he thinks it's worse than I do. But anyway, let's move on to some a little more substantive kinds of stuff today. Do you have anything you want to comment about with the CFPB, maybe the sort of the before times, Cordray, Kraninger, Chopra, to what we're looking at today, and how to put that all in perspective? It's just a very odd, turnabout that we've seen.
So here's what I would say about the CFPB. The CFPB was a good idea. It was the right idea. It came on the heels of the financial crisis of 2007 and 2008, which almost brought not just our economy, but the entire world economy to its knees. So something was needed. Something had to be done. So on paper, it was a good idea. It's a shame it couldn't be, part of the FTC, which is our nation's, consumer protection agency, or something else along those lines. But Congress chose to set this up separately. But from even before the day the CFPB became operational, in all honesty, it was bastardized. Okay, it was turned into and made to be a political agency in the worst sense of the word. And it was destined to fail as a result of that. I'm sorry to say that. I don't want to be too harsh on people, but I think, an administration that came in, the Cordray administration, who immediately decided from day one, I don't care what a rule says. I don't care what an interpretation is that's been outstanding for 40 years. I think something differently, and I'm going to change it. I'm not even going to talk to you about it. I'm going to take an enforcement action. I'm not going to talk to the industry about it. I'm not going to do notice and comment rulemaking. I'm going to take enforcement actions based on that. Okay? That right there, destroyed the agency from the very beginning, in all honesty, and created something that would not be able to last, in all honesty.
But do you think that was also, I mean, you can lay that also at Elizabeth Warren's doorstep as well? I mean, wasn't that the agency that she wanted?
Yes, I think it probably was. I didn't talk to her about it. I think it probably was the agency that she wanted. And Elizabeth Warren is a Democrat and a senator. She could have been a Republican for what I was going to say, but she's political. And she did want some. I would think that she wanted something political along those particular lines. But I think it was a mistake. I think it was a mistake. And regardless of whether or not that's the agency that she wanted, that's the agency that was created by Richard Cordray. I mean, he was the director of the agency, and he allowed that to happen. First action he took, was against PHH Mortgage, on captive reinsurance of MI insurance, when PHH showed them the letter that was more than 20 years old from HUD that was responsible for RESPA saying you can do these things.
Well, let me just say that the industry owes you and PHH and the other attorneys that fought the CFPB on that a debt of gratitude, because you're the only ones who fought the CFPB. Everyone else would cave and do the consent orders, and we got a good decision out of that. But it took what did it take, Mitch? 6 years to get that?
Yeah, it took almost 8 years to get it, to tell you the truth. But PHH did the industry a great favor. They were great clients. They had that right, and they actually had no choice but to take that on. They absolutely had no choice but to take that on. And part of that was the actions of the CFPB and the threats they were making and the things that they were asking for and things along those particular lines. You never really want to fight with a regulator if you don't have to. I will tell you that case proceeded because they had no choice. They had to fight with that regulator. And I will also tell you that as lead counsel in that case, there was never a doubt in my mind or any of the other attorneys' minds what the ultimate outcome was going to be, because it was just wrong. You had a statute that was enacted in 1974. You had regulations that had been in place for 40 some odd years, okay? And you had a new administration, a new agency come in and say, I'm throwing that all out. We're reading this differently. This is what the Administrative Procedures Act is all about. You can't just step in and do something along those particular lines. And, one of the things that over time, and this started in law school as I was studying administrative law and other things, that became really important to me was, our system of checks and balances that we have in our government. And our system of checks and balances through the Administrative Procedures Act as well. Because you have bureaucrats, you have hardworking government employees, but not elected employees who are making decisions. And, the reality is they're making law. Congress passes a statute, right? The agency issues regulations. The law is really the regulations itself comes through that. And when they go rogue, they don't even bother changing the regulation, and they just change their guidance or their interpretation or something else along those particular lines. Those are the laws that we all have to live with, right? And so there has to be a check in that. So when something like what happened to PHH happened, okay, I thought, oh my God, this is the ideal case in the world to be taking up. I have to take this case up. Right? I have to, because you cannot let the federal government or any government, okay, just run wild and just dictate without going through the process that has been set out. We're a country of laws, and what's held this thing together 250 years are those checks and balances and the processes that are set out to make sure that it's fair. And listen, I know a lot of people talk about the Trump administration. I'm not disputing what a lot of people say about what goes on today as well. But in its own form, this happened with the Democrats as well, in the manner in which they were pushing a social agenda, a different agenda, without going through notice and comment rulemaking and without jumping through the right hoops for it. And that's really problematic.
Let me ask you, I know you didn't do it lightly. and you said your client had to do this, but what impact did that have on your ability to work with the CFPB on other things? I mean, does that factor into your calculus of like, well, I've got to be really careful about how we do this, or you just got to do it?
Never factored into, and these things to date. I mean, I just finished a case with the CFPB at the very end of the Biden administration as well. My relationship with them never factors into my representation of the client. I am cordial when I litigate, but people will tell you I'm pretty strong when I litigate as well. And it's interesting because, and to the credit of Richard Cordray and others at the CFPB, my representation of PHH and others, I represented a number of different cases, against the CFPB, did not harm a good working relationship otherwise. It really didn't. And that's, that's actually more to their credit than mine. I can't worry about something like that. My job is to represent my client to the best of my ability, right? And you hope that it's not going to impact your relationship or get in the way of your being able to handle other clients in front of them. And it didn't. And I give them credit for that.
Well, I take it that the Cordray folks didn't call you a leech that like the Chopra called regulatory lawyers. I thought that was a little.
They didn't actually. They didn't.
A leech that only wants to pad their billable hours, I think, was the.
I did not get any of those things, but I do get sometimes, when I, especially, in the last administration, I did see emails through discovery and things like that saying, "Uh-oh, Kider's on this case," and I took that as a compliment. I thought that's great.
Well, I mean, you would hope that the regulator has a sense of professionalism that recognizes that your job is to represent your client, as long as you're being truthful, but you can be forceful at the same time. I mean, they should respect that and not, think that it's a personality thing and that they don't like you because you're representing your client well. And
they handled that, for me at least, they handled that really well. I never took it personally with them, and I always found them. I mean, I don't think they were fair to the lenders that they were regulating in any way, shape, or form, but I always found my personal dealings with them, or my dealings with them on cases, to be fine, to be fair.
All right, you ready to hit a few regulatory topics?
Sure. What do you got?
Do you want to stay on RESPA? You have anything you want to talk about with RESPA? Because that PHH case obviously was about HC2 and services rendered exception, but we're seeing a lot of interesting cases, I think, RESPA-wise, that are being brought by states, mostly in the intersection between RESPA's exceptions and what I would call sort of generalized unfair deceptive kinds of concerns. Both we've seen some class actions on the West Coast and some state actions, state AG kind of actions against affiliated businesses. Obviously RESPA is 50 plus years old. And it is in a sense, a form of unfair deceptive kind of law, but it's very specific in its approach. What are your thoughts on what you're seeing right now and with some of these states and the class actions?
Well, I think we're seeing a couple of different things. I think we're seeing some states that feel that they have to jump in, okay, because they're not seeing any type of enforcement that's coming from the federal government. Some of these states have a lot to learn, in all honesty. Some of these states have not been very active in RESPA in the past. And yeah, I think you're right. I think they conflate at times a deceptive practice with a Section 8 violation. Section 8 is very specific. It's very specific. It's an anti-kickback. anti-referral fee provision. That's what it is at its heart, right? And states stepping in and, conflating that with a deceptive practice. Sure, it's a deceptive practice to get a referral, but they go beyond that. I mean, what they're looking at is, well, how did you structure something? And it must be deceptive, because it violates RESPA, because, one of RESPA's exceptions wasn't properly followed, it doesn't fit, or anything else along those particular lines. So, I mean, listen, they're carrying the torch forward, is what they're doing. The federal government is not enforcing RESPA. I can't really see them, not in this administration, at least not in this administration today, doing much by way of RESPA enforcement. And so you've got these situations where, you've got attorney generals. Look at the state of Pennsylvania, for example. They took a look at a mortgage broker that, that had, that effectively gave shares or sold shares of their company to real estate agents. And the Pennsylvania State AG stepped in and said, wait a minute, I'm taking a look at this, right? They didn't pay the fair market value for it, right? You're giving them something of value, and you're doing it solely because they're referring business to you. The fact that your motive is to do something because they're referring business to you shouldn't matter. That shouldn't matter at all. But the payment structure should matter, right? Are you overcompensating them? Or in this particular case, are you effectively giving them something for free, right? I don't actually view that as a deceptive trade claim. I view that as a RESPA claim. But in this particular case, the argument was that these real estate agents that now had an equity interest in these mortgage brokers and were referring business on, they weren't giving affiliated business disclosures. So now you're crossing that line into a deceptive trade claim, deceptive trade practice, because the consumer, number one, RESPA doesn't require it. And number two, from the perspective of deceptive practices, the consumer needs to know. If I'm going to send you on and recommend someone else, they need to know that I have a relationship with you, or that I'm a part owner of you, or something else along those lines. So I'm not terribly bothered by the types of cases that I'm seeing. I'm not making a statement about the facts because I haven't looked into whether or not the allegations are correct or not. But I'm not bothered by the manner in which they plead those.
Okay. How about we move to LO Comp? What do you think is going to happen with that? Between a CFPB that has maybe not enough employees to deregulate in a proper way with the drafting and the language that needs to be proposed in order to properly address the concerns of the industry with LO Comp. What do you think is going to happen?
Well, I think this administration has no interest in LO Comp. I think the administration believes that, anyone's compensation, including those of a loan officer, should not be regulated. That's what they believe. I think the Mortgage Bankers Association and many lenders have done a pretty good job of educating the administration as to the implication and consequences of just getting rid of LO Comp in its entirety. I am told by sources inside the administration that as a result of that, they're going to try to do something a little different. In other words, they're going to try to address the concerns of the industry, right? And then do away with everything else. But you asked the right question. Can they do that? Do they still have the expertise? Will they have the expertise? Who's going to write these regulations? How much time do we have left? Because if you want to do it the right way, you're going to make those changes. You're going to go through notice and comment rulemaking, right? And you're going to give everyone an adequate time to respond to it. And by the time you're ready to finalize a rule, you're at or near the end of the term of this administration. That's just the reality of the way the system works today. And so I don't know what is going to happen, in all honesty. I mean, it's been a while now. I think it was in the summertime that the CFPB, I think it was August, when the CFPB came out and sent something over to the OMB, and they talked about rescinding LO comp itself. Nothing really much has happened since that point of time. You know, there are a number of people who would call themselves libertarians that are in the White House right now and responsible for these laws. And I think they're having a hard time in their own minds, because a libertarian doesn't believe that the government should be involved in regulating someone's compensation.
Yeah, I know. I've written a few of my more confusing about that.
Yeah. So how's it going to end up? I'm not sure how it's going to end up. I would think that reasonable minds within the administration will come together and make their best efforts to change this rule, to make it a lot easier on lenders, and to make it more uniform across the board, and to allow for things like different payments for down payment assistance loans and HFA loans, to allow for things like recouping losses as a result of loan officers' negligence, in originating a loan, and things along those particular lines. And otherwise, may just leave it pretty much the same, but we'll see.
Yeah, I actually feel, maybe you correct me if I'm wrong, but I feel like there was a lot more urgency around getting rid of it. That whole kind of idea that really it's just an unnecessary, actually anti-competitive law that they really shouldn't have. But the complication of getting rid of it is that you can't just, from a regulatory perspective, do that. You also have to get rid of the statute or amend the statute. And once they realized how complicated it was, it just kind of got set aside. And I'm not really sure what the urgency is anymore. I hope there's still urgency. We're just not hearing anything. So, something to stay tuned to.
So I think you're absolutely right. I think that's exactly what happened. I think the urgency came about without a full education as to what the issues are. And that's always problematic. You don't want to shoot first and then ask questions.
Absolutely. Gosh, well, I have a whole bunch of topics, and I sent you a whole list of topics.
Go
We
ahead.
could talk about the GSEs. We could talk about AI. We've only got about 2 more minutes scheduled.
Well, let's
tell you what.
Let's do this if I can.
Yeah.
I
Please.
think there are 3 things that everyone should be attuned to. And I think there are 3 things happening in our industry today that are going to have tremendous impact on mortgage finance and mortgage banking. Okay. And you named 2 of those things. One is AI, and the other one is GSE, Fannie and Freddie Mac release. Okay. I tend not to get hysterical about these particular matters, but I will tell you this: AI is going to change the nature of which we both originate and we service loans. What's happening in AI is absolutely amazing. And some of the systems that are created and will be created are so efficient, margins may well come back to this mortgage banking industry yet again. So I think AI is going to dramatically change this industry. And I haven't seen anything for the last 20 years that I thought was dramatically going to change the industry, but AI is going to. The other thing that people need to look out for is GSE release, okay? This administration says they want to end conservatorship for Fannie Mae and Freddie Mac. I don't actually think they'll end conservatorship, because for a couple of different reasons. I don't think they will end it because, again, it's one of those situations of shoot first and ask questions later. But when you ask the questions and you realize the implications that has for credit availability in the country, you realize, whoa, we have to be really, really, really careful about the manner in which we handle this, right? Because Fannie Mae and Freddie Mac, they are the markets. Everything else is really on the fringe. They are the market. So what will they do? You know, if they can settle up with existing shareholders, they can amend the agreement that the government has. You know, they'll go ahead and they'll release some stock, 5%, 10%, something else along those particular lines. You know, so I think the government will still be in it and always be in it. And it's interesting because I saw a Trump commercial for Fannie Mae the other day. And it's going to be a very big issue in 2026 because affordability is on the calendar. I mean, the Democrats are pushing affordability, and affordability is a huge problem in this country, and that equates to housing affordability in large part as well. So I think that, you know, certainly in the next year, you're not going to see them come out of conservatorship because the federal government can use Fannie Mae and Freddie Mac to help a little bit on that affordability issue, on that question. But I think people really need to watch that because, you know, if those that are just yelling, take it out of conservatorship, if they ultimately win the day, that's really going to disrupt our market. That's really going to disrupt our market. And the third thing I would say that I think everyone needs to look out for is new business models. I think you have to take a look at the Rocket, Redfin, Mr. Cooper deal, you know, and there are others along those particular lines. You look at the Bayview deal with Guild, Bayview being the second largest servicer in the country, and Guild being one of the largest retail lenders in the country. You take a look at that, and you take a look at the Zillow model with all the data that they have and how they plan on using that data. Those business models can change the nature of the industry and actually will have an impact on how many lenders there are. Will we have 5 servicers at the end of the day? Will we have 4 services at the end of the day? How many originators are we going to have? Because as these servicers get bigger and bigger, and as this business model mandates that, you know, they need the data, they need the consumer, so they acquire more and more servicing. The mid-sized servicers, they can't buy. They cannot compete with the large servicers in buying MSRs and doing things along those lines. So the servicing industry is going to change dramatically. And you're going to see those very same winners in the servicing industry, they're all jumping into retail originations as well. They're all hooking up with those retail originations. And we're back to this concept of one-stop shopping. You've got your Redfin now, along with Rocket. You've got many other companies that now have affiliated real estate companies. So I think the dynamics of the mortgage banking industry is changing and is going to change dramatically. Okay. And, you know, to say that I don't have concerns about our overall finance structure, I would be lying. Not that I'm making a judgment as to whether or not these model changes are right or wrong or good or bad, but we've had such a good and effective housing finance system in this country, more so than anyone else. People are able to get into homes. People are able to move up economic strata as a result of it. I think we have to take that into consideration as we watch what's happening with these other business models.
Yeah, well, thank you so much, Mitch, for your time. We're all out of time here, and I want to also thank our sponsors, Polonsky, Beidel, and Green. Just to wrap that up, by the way, I did hear that to combine 2 of the points that you made, that Fannie Mae commercial had Donald Trump's voice, but it was generated by AI. So we got 2 out of the 3 in one moment there. Anyway, thank you again. It was really a pleasure speaking with you. And again, thanks to our sponsors. And we'll see you all next month on the 3rd Tuesday of every month.
Thank you, Brian.
Take care. Bye-bye, everyone.